Welcome to ForexTV.com's PM Exchange. It's Thursday, February 7th. I'm Remy Hoki. Today I'm joined by Joseph Trevisani, Chief Market Analyst at FX Solutions. Good afternoon, Joseph.
Hi, Remy. How are you?
Great to have you on today.
Thank you.
Well, in today's session, we saw the U.S. dollar continue to be supported against the euro. And earlier this morning, we had both the rate announcements from the ECB as well as the BoE. So let's start out with what we saw in price action for euro dollar, which hit a low of 1.4440.
Right.
So going forward, what do you expect to see in euro dollar?
I think we may have reached, the apex of the pendulum swing. I think it's now starting to move back the other way. The markets had long been anticipating, without any particular help from the ECB, in fact, active hindrance from the ECB, but the markets have been anticipating, traders have been anticipating a rate cut by the ECB, a rate move to the neutral side at the very least, which we got today. One of the more interesting aspects of this was the market really did, and traders really telegraphed this for the past 2 weeks. It has been a very long run of very dollar-weak moves, both by the Fed, with its unexpected rate cut. It's followed by a 50 basis point rate cut, and a string of very bad U.S. statistics, none of which drove the dollar appreciably lower. Clear signal. The market and traders didn't want to take the dollar lower. They were just looking for a signal, and I think we got it today.
Well, as you mentioned, we have been seeing weak data both on the employment front here in the U.S. and also the weak ISM number. And watching what we've been seeing in price action for the sterling, earlier today the BoE cut by 25 basis points to 5.25%, and the sterling has pulled back under 194 against the U.S. dollar. So going forward, what do you expect to see in price action for sterling?
Well, sterling is an interesting case. The market traders had pretty much expected this. It was a universal expectation that they would do this. So you had already priced into the sterling level this 25% basis, this 0.25% cut. Going forward, they seem to be a little more reluctant to continue, or at least to let the market anticipate future rate cuts. So you're probably going to see a bit of a pullback, meaning the other way, a little bit higher in the sterling, because they're not going to anticipate as much coming. The thing for the ECB was, although it was widely, I wouldn't say rumored, but widely perhaps hoped for, there had been no indication from the ECB prior to today that they would change their stance. There had been some indications from the BoE.
Well, before we shift our focus away from today's rate announcements, if you could shed light on Trichet's comments today. He highlighted downside risks to growth,
yes,
and also mentioned that 4% rates allow for price stability. So how does that translate into what we'll see going forward for the European currency?
Well, you can take the first one's kind of fun. He said that they anticipate future downside risk to growth. Where have we heard that phrase before? Of course, we've heard it many times from Ben Bernanke. Obviously, it's true, and the numbers that they're looking at internally clearly predict this, and that's why they've moved to this. As for the 4% ensuring price stability, that's certainly a new view from the ECB, because up till now, not so much Trichet himself, but some of the other board members, especially the German board members, have been keeping up quite a drumbeat for the potential we could, as they say, raise rates if we have to. Well, of course they could. No one ever thought that they would, but the change in rhetoric is quite significant.
And moving on to another central bank, the Reserve Bank of Australia, which hiked earlier this week by 25 basis points, which puts their interest rates at 7%. That's quite a gap from the U.S. right now,
certainly
a 4% gap. But given the fact that we haven't seen Aussie dollar retest the high of 91 we saw on Monday, do you think there's more upside for the pair or downside?
I think there's more downside. The joke is, I suppose, that because they're down under, they got it backwards, and they raised their rates while everyone else is lowering rates. That's obviously not the case. They have pretty strong growth. They're looking at high commodity prices, which leads to inflation. Mm-hmm. So their rate move is sensible within the context of their own economy, which, of course, is the first line of reasoning for any central bank. However, I really don't think that you're going to see much further in the way of rate increases, and neither do the traders of the Aussie dollar, because instead of rising, it fell. And I think that the move in the Aussie is going to be on the downside. And even though their rhetoric was relatively anti-inflation, I don't think you'll see any moves, and I think that will come to the realization of the market, and the market will continue taking the Aussie down.
Okay, so while we're still on the topic of the Aussie, what do you expect to see in the Aussie yen cross going forward?
And that's a very interesting question. You know, with the Aussie at 7%, it would seem that this would be a great carry trade play. However, the carry trade, as we noticed, is, if not dying, it's certainly rather ill. It's very, very averse, as everyone says, to world risk, and it has been going down steadily, and I don't think you're going to see a return to that particular aspect of it. So I would still look for the Aussie yen and the Kiwi yen to come off along with the euro yen, despite that slightly increased, I mean, it is after only 25 basis points, increase in the rate gap.
Okay, I'm looking ahead to this weekend as well as next week. This weekend, all eyes will be on the G7 meeting, which takes place in Tokyo.
Right.
And as always, ahead of the G7 meetings, there are expectations that the major foreign currency pairs will be mentioned.
Right.
But do you expect to hear anything of significance out of this meeting?
I don't. I mean, I'm never much of a fan for G7 meetings, although every once in a while they do something. Their major currency exposition at prior meetings have been to either gently or otherwise chastise the Chinese for not appreciating the yuan quickly enough to satisfy Western governments, primarily Western political alliances back home. I don't think they'll do that this time. A couple of reasons. One, the yuan has been appreciating quite substantially against the dollar, and not so much that it has moved to an appreciation phase. It hasn't. It's that the actual speed of appreciation has almost doubled from 2006 to 2007. It's a pretty substantial move. The Chinese are probably not going to change that because they have their own domestic problems, inflation and almost very expansionary growth, which this will help with. The Europeans, because at the same time the yuan has been appreciating against the dollar, it's been depreciating against the euro. So this gets the Europeans upset. However, one of the reasons for that is because the euro has been appreciating itself against the dollar. So with the euro starting perhaps to depreciate, take some of the sting out of that. And I think with the Europeans also now worried about the worldwide financial crisis or bank crisis, whatever you'd like to call it, and with sovereign wealth funds around the world helping the West in that case, and Europe as well, I don't think it's going to be a propitious moment for chastising the Chinese.
Okay, Joseph, and before we wrap it up for today's interview, looking ahead to next week on the data front, both here in the U.S. as well as overseas, what should traders be watching out for, and any other themes that you expect that they should focus on going ahead?
Well, in the United States, we have retail sales. I mean, I don't think we're going to get, it's not going to be, well, let's put it this way. The Fed has already made its judgments, and nothing that retail sales, no retail sales number is going to change that. If it comes out very poorly, let's say, oh, the Fed was right. If it comes out very well, they say, well, okay, it's not quite so bad, but the Fed's going to continue to reduce rates. So I don't think it's going to matter that much. We also have the TIX number, which I think is indicative of some of the health of the worldwide system, the worldwide financial system, and the U.S. dollar, as far as it's viewed from overseas. There was a period late last summer after the credit crisis, it blew up, when there were negative flows to the United States. And if this is prolonged, of course, that's a serious problem since we run a deficit every month. Those negative flows only lasted for 2 months. So I don't think you're going to see any real concern there, but it will be watched. For traders, the thing that I would say is when we look at the way traders make their positions, they always, the most successful traders, will jump as soon as they have a conviction. They won't wait for proof, for evidence from the markets. If we look back to last August when the credit crisis blew up in the United States, there was really no verification of this in any economic statistic that was out up until that point. Everything still looked pretty good. We had just gotten GDP numbers from the third quarter, which were very good. Nevertheless, the market and traders jumped quickly, and they drove the euro up quite a bit over the next several months. I think we may be in the early throes of a similar move now. So even though you haven't seen the statistics that would indicate it's time to buy the dollar, it may very well be time to buy the dollar.
Okay, Joseph, thank you very much for insight, and
You're
I
welcome.
look forward to speaking to you next week.
Thank you.
This has been your Forex News with Joseph Trevisani, Chief Market Analyst at FX Solutions. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks closed out the session in positive territory. The major indexes saw seesaw action throughout the day but ended with a gain. The Dow fell as much as 80 points and was up 130 during the session. Wall Street continues to weigh the possibility of a recession and today saw disappointing data as well as corporate news. This included the decline in sales at major retailers as well as Cisco's disappointing outlook. In U.S. economic data releases, initial jobless claims fell by 22,000 to 356,000 in the week ended February 2nd. The 4-week average of initial claims rose to 335,000. Meanwhile, the National Association of Realtors said its pending home sales index fell 1.5% to a reading of 85.9 in December. That's from a downwardly revised reading of 87.2 in November. At the closing bell, the Dow Jones Industrial Average rose 46.90 to close at 12,247. The tech-heavy Nasdaq rose 14.28 to end at 2,293.03. And the S&P 500 rose 10.46 to close at 1,336.91. In the fixed income market, U.S. Treasuries fell following the afternoon auction of 30-year long bonds. Demand was disappointing for the $9 billion auction. The 30-year long bond closed down with its yield at 4.49%, up from yesterday's 4.36%. The benchmark 10-year Treasury note fell with its yield at 3.73%, up from 3.6% late Wednesday. And the 2-year note fell with its yield up at 1.99% from 1.93% in the previous session. In energy, crude oil futures gained, closing up above $88 a barrel. March crude gained 97 cents to settle at $88.11 a barrel on the New York Mercantile Exchange. The front-month crude contract fell as low as $86.24 a barrel, its lowest price in over 2 weeks. Taking a look at petroleum products, March heating oil gained 3.97 cents to end at $2.45.85 a gallon. March gasoline futures added 2.79 cents to end at $2.2678 a gallon. Earlier today, the EIA reported that nat gas inventories fell by 200 BCF in the latest week. Natural gas for March delivery rose 10.8 cents to settle at $8.102 per million BTU. Over in the metals complex, gold futures rose today with April gold gaining $5 on the session, settling at $910 an ounce on the COMEX division of the NYMEX. Earlier, the contract hit a high of $915.20 an ounce. Other precious metals also rose on the NYMEX, with April platinum hitting a record at $1,855 an ounce before settling up by $32.40 at $1,851.40. March silver added 22.5 cents to end the session at $16.775 an ounce, while March copper gained 14.5 cents, ending at $3.4540 a pound. This afternoon, we're joined by Bobby Firestone, analyst at Aileron Trading. He'll weigh in on recent price action in NYMEX crude oil and COMEX gold futures.
It looks like crude has found some support today after the strong slide we've seen in recent days. Now, the big news as far that we've seen come out is really production-related. Nigeria, its Shell there has announced they're going to be halting 130,000 barrels a day of production because of a leaking pipeline. And yesterday we had news coming out of the North Sea that 280,000 barrels of production a day were going to be taken offline. Now, combine that with a little bit of short covering after and the strong drop we've seen. Okay, we found a little bit of support. I don't expect it to really last. The focus will quickly return to the economy and the credit crisis. I'm really looking for a slide to 85 and probably lower ultimately, as the credit crisis just continues to weigh on the overall impression of the economy because the Fed's not fixing the problem. Now we go over to precious metals. I'm a long-term bull on gold, but at 915 or at the price area we're looking at 915 as near-term resistance, and it just looks expensive. I think we're going to need to see a deeper pullback, get a day where we get some nice panic selling, just kind of wash out a lot of the weak hands, and set up a fresh base to make a push higher to try and take out that high around 940 or 950.
That was Bobby Firestone, analyst at Aileron Trading, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.